Today, I have one of those podcast opportunities where I get to talk to two of the most knowledgeable people in the region when it comes to private equity financing, when it comes to venture capital. And one of the things that we want to talk about today is how we value a company, because a lot of us get sort of thinking our companies are worth more money than what they really are, especially when you've had a little bit of success. You've got this, sweat equity that you put into it, and you've got all this emotional attachment to your business, and sometimes we think it's worth more than what it really is. And I think knowing what the value of your company is very important, because especially if you're going out to raise more money, you need to know, hey, how am I going to raise money against this company? How do I value it? Today, we're going to talk about that. And I'm here today with Lokesh Sikaria. He is the founder of Moneta Ventures. You guys are a venture capitalist here in the Sacramento region. You invest into early stage companies, but they've got to have revenue, right, Lokesh?
Yeah, $500,000 to $10 million in revenue.
And then I'm also joined by Curt Rocca. He is a private equity man. He owns a company called DCA Capital. And Curt and his company are invested into more mid-sized companies. Is that right,
Yeah,
Curt?
we focus primarily on companies from 10 million to 100 million in
Okay.
revenue. So where Lokesh stops, we start. Occasionally we cross over.
Yes.
And try to support one another.
Okay,
But
so,
between the two
yeah.
of us, nice thing is between the two of us, we cover a pretty broad portion of the ecosystem here in the community.
And here I am. I'm an angel investor, so I'm the lower level or the earlier stage. So they get past me, they get to Lokesh, they get past Lokesh, they get up to you. What a team in the making here in Sacramento. So look forward to diving into with you guys how we value companies. But maybe we can just get a brief, I guess, what's your investment thesis, if you don't mind, Curt? What do you guys look for in investment?
Sure,
Is it a certain size?
I mean, at a core, we look for promising, growth-oriented companies that have a good management team, some form of sustainable competitive advantage that we think is a good bet for generating. We try to typically target roughly 3 times our money during our investment horizon. We take a little bit less risk than Lokesh does and a lot less risk than you do. And so our returns have a tendency to be tempered a bit, which means our valuations can be, we would say more generous. Again, to your point later, a lot of people that we're negotiating with don't necessarily don't see them in that same light. But that's really what we're targeting. We focus almost exclusively within the greater Sacramento region. So we'll go down to Fresno, we'll go north up to Redding, we'll go over to Santa Rosa, over to Reno, and that really is the core of where we strive to invest.
And what's average investment size?
We'll typically invest anywhere from 2 to the largest investment we made was $27 million.
Oh, wow.
So,
Okay.
we can scale up. I mean, part of that we invest out of our own fund, and then if we find investment opportunities that are greater than we can do internally, then we have a pool of investment partners that we'll bring in to co-invest on the same terms alongside of us.
Okay, gotcha. How about you, Lokesh? What's thesis?
So the thesis is that we invest in companies, early stage companies, doing between $500,000 to $10 million in revenue. Like Curt, we like to focus in the Sacramento region too. We also have an office in Austin where we deploy close to 30% of our fund.
Oh, okay.
In Austin, Texas, and 70% is in the Sacramento region. In addition to what Curt laid out as the criteria, one other thing that we look for is companies in the technology sector and healthcare sector. So we don't like to go beyond those 2 sectors in terms of what we invest in.
Okay.
Typically.
And what's the average investment size?
So we typically from the fund we would invest $500,000 to $2 million as an initial check. But we have also been part of rounds which are 10 million plus, where our partners in the Bay and others join in those rounds.
Okay. All right, I think that level sets it for us a little bit. At least we know kind of like where you sit, and our audience can sort of get a flavor for what expertise you bring or where your action is today. So maybe let's start with you, if you don't mind, Lokesh, and feel free to chime in here, Curt, because you're very familiar with companies at all, at all aspects of their journey. So earlier stage companies, typically at that level, they've got some angel investors behind them. They've got some revenue. How do you value these companies? Do you have a methodology?
Yeah. So one of the things we learned is that when we started out, we had a lot of our own ideas of how we value things and all of that. But over time, what we realized was that our methods were giving the same output as what was already prevalent in the market space. So you try to be different. You think you have very innovative ways of valuing things, but at the end of the day, you end up with what the market is at, right?
So the value of a company is what somebody will pay for it.
Well, yeah, it's up to some extent, but there's essentially two methods that are used, right? So one is what's called the venture capital method, right? So when we started out, we thought, well, we won't be like that, but when you look at it, at the end of the day, that's what we do, which is we put a time horizon to the company and say, well, Mark's company in 3 years, we think can grow to 25 million in revenue. And at that point, because of their revenue profile, they should be worth 50 million, right? Then what we do is we say our internal rate of return that we expect from that money, we have that. We put that factor in there and work backwards and say, well, Mark should be valued at $10 million now for us to achieve the internal rate of returns that we are looking for.
Okay.
So that's one method of doing this. The second method, and a rule of thumb, which I advise entrepreneurs to think about a lot of times, is if they have a lot of recurring revenue, Mark, and they have over $1 million in revenue to start with, I want them to use this basic formula. And the basic formula is, it says, take your current revenue, yearly revenue, multiply that by your growth rate over the last 12 months. So let's say you were $3 million, you grew to $5 million, so your growth rate is 40% or 60%, right? Okay. Multiply that percentage in there and multiply it by 4 to 6 times. And that gives you a high-level ballpark estimate. So that's the second method we have used quite a bit to just,
okay, let's start with the first one, because I don't know if I understood the second one completely, so I may need you to slow it down for the C student here.
Absolutely.
So the first one, you're doing a forecast, and you're estimating where that company will be in sometime in the future. 5 years from now, it should be 10 times as big. I mean, so the growth rate, so I'm thinking of things that, I'm challenging this a little bit. Some companies are valued more on the top line. Others are valued somewhat more on the bottom line. And ultimately, it becomes about how much money they're making. Is that right? So is there, do you think more of top line, or are you more looking at the EBITDA line?
So take that example that I just laid out, right?
Yeah.
So if we think Mark's in the business of providing software as a service, the typical multiples in the market space are 6 to 8 times for mature, software as a service companies. We think Mark can get to 50 million in revenue in 5 years. We put that multiple on there, so we think Mark can be worth 300 million to 400 million as a company. We have a certain internal rate of return that we want out of that investment.
Right.
We put that on there and say, based on that, Mark should be worth 50 million right now. So we will invest based on that 50 million valuation.
Gotcha.
Right?
So it's comparisons. So you're basically doing comps for other like companies. But you're not doing comps for like companies at this level. Let's say that they're $500,000 in sales today. That number is not as important to you as where it's going to be.
Exactly right.
Okay. Curt, you find that similar, or did you have a follow-up question?
I did have actually a
Yeah, go
follow-up
ahead.
question because Lokesh and I were all too busy. We never get a chance to talk to each other about these things. So, but one of the questions that I would have that the audience may have as well is, so when you're looking at that, coming to that $50 million
Valuation.
conclusion, well, in that case, it was $50 million in revenue,
Yes.
right? 300 million-ish in value.
Yeah.
So generally, the company, I assume the company's providing their projections, or are those
Yeah,
projections
and
that
they
you're doing
don't
internally?
usually factor into our math.
Well, and that was sort of my question was, you're going to get this set of projections from the company, which, at least in our experience, have a tendency to be done somewhat with rose-colored glasses, right? Because, nice thing, I was having a conversation actually earlier today with someone on this very subject, talking through valuation. And, one of the things that strikes me always is that, in this particular case, they said it took us 11 years to get here, but invariably it's this next year where everything's going to go right, right? It took them 11 years to go from where they started to where they are now. But this year, everything's going to go right. All those things that caused them to slow down and all the bumps that were in the road, the pavement is perfectly smooth now. The sun is out. Everything's green and growing. And so I was curious how you sort of both reconcile management's projections to where you ultimately come out, and how you have that conversation with the business owners to help them understand where the difference in view might be.
Yeah, and so keep in mind, because these are early stage companies, typically there is not a lot of history. So in your situation, you do have 11 years of history, and you're going, hey, why in the world will you suddenly now grow so much more than what you did in the last 11 years?
Yep.
In our situation, what happens is there's maybe 2 years or 3 years of data, right? And now we're trying to come up with the basis to say why this company will continue growing at the rate they are, or why it will increase. So that's where all these other factors come into play, right? The management team, what kind of existing clients they have, what kind of pipelines they have, what's the backlog. Looking at all those factors, do they have something unique about their product which will make create a demand for them? So all those other factors kind of come into play there to determine that revenue. And for us, what we do is we have 5 partners. When we come to a final conclusion around a deal and the valuation, we have independently each of them enter what they think this company will be in revenue 5 years from now, and what the multiples will be at that time, right? So it's a collective group think, right?
Yes.
And come to some sort of conclusion. And what we invariably find is we are in the same ballpark.
Is there a base case, though? You create a base case, and you know that you might be, it might go lower, like almost like an expected worst case. And I guess in early stages, I mean, it could go to zero. It's not that uncommon to go to zero. And then there's obviously, you could hit a home run and it could just blow up, right? So, I mean, how do you, how far away are those ranges?
And this is the 50 million in revenue in my example would be the case where we think it's the most realistic to hit, right?
Okay.
So from there, it could be both north and south. It could be very different, right? It might end up being a 20 million situation, and we model it out there and say, what would be our returns in that scenario? If there's 100 million in revenue, what's our return in that scenario? But the 50 million number that I gave, Mark, is basically what we think is our best guess estimate of where they will be at that time.
And when you just, if I can follow up, and what I was really trying to get to with the other question is, generally, when you come to a $50 million conclusion, my sense is the management team's projections were probably 100 or 150,
Absolutely.
right?
And you're right. And in majority of there's rarely a situation where the management team's projections is lower than ours, right? So no, absolutely right. The management, those tend to be a little bit rosier. And sometimes, because they might not necessarily have had the experience of building a business before. And sometimes just because they're, optimistic by nature, that's why they're entrepreneurs.
Which you want, right? Who wants to invest in someone that doesn't believe that their business can take off?
Right.
I mean, so
Exactly
generally, as a fundamental principle, you want that dynamic, right? Where you have a management team who really is passionate and believes in it, and candidly doesn't want to give up more than they have to because they believe in it that much. And so you can't really question the motives, but does have to be tempered with some sense of realism.
Well, one of the things you mentioned were some of the factors that you use. You talked about management team. You talked about pipeline, market position. I mean, do you give each of those some sort of score in your probability rankings?
Yeah, so that's where I was. When we started out, we had a very quantitative model about it, and then we used to come to the same conclusion as the venture capital
Okay.
method, right? So we abandoned the quantitative method and said, okay, you know what? We have to score it so that we know that there are no red flags. Right,
Gotcha.
but it doesn't weigh in very heavily in terms of directly saying, "Oh, they scored this much on this criteria, and therefore the valuation should be this." Right? It's not a quantitative model anymore, right?
Yeah.
But these are all factors that go into the valuation.
Can I dive into that and make sure I understand that? So I'm thinking of these as like, if we talk about the people side of things, the executive team and so on, is that a check the box, or does that actually make the value go up? Oh, that guy's got a CEO that has built companies in the past and sold them. Okay, the company value goes up, or is it more like a check the box?
No, it does factor in the valuation qualitatively.
Okay.
Right, but it isn't like a proportionate thing. Says, oh, well, we rated the management team 8 on a scale of 10, and therefore the rating adjusts this way. Right.
Okay.
So, couple more factors that I want to list in those is the efficiency in terms of using the cash. Right. So far, so if they build the business which is $3 million in revenue, but they've used $15 million to build it, that's not the same as a business that took in $1 million and built a $3 million business, right? So it has to factor in the valuation somewhere, right? The cash efficiency that's there. The churn of the customers. We've seen,
Yes.
we've got stuck at opportunities where we see just a high churn in the customers. So what that means is that the sales and marketing engine has to be amazing, because otherwise, you're not going to retain enough customers and things like that. So that's another thing we look at. Cost of acquisition of the cost of acquiring the customer, right? So all these things play a factor, right? But at the end of the day, all these kind of provide that qualitative input into saying this is where we think the revenue will be and this is where we think the valuation will be, and then we work backwards from there.
Okay. So let's jump over to you, Curt, and we can bounce around a little bit. But so the companies that you're looking at are further along. They're profitable.
Yep.
How do you value a company that you're looking at?
I mean, honestly, it has a lot of the same fundamental factors that Lokesh talked about, but we do have the benefit of looking backward and seeing what historically the company's done, and so that gives you at least a base level starting point. It's very rare for us to look, as we were talking about earlier, look at a company that, let's say, it's had 10-15% annualized growth, to not see the projections all of a sudden be 25 to 35% growth, and part of that is justified because if capital's coming in, hopefully there is a fundamentally good use of that capital to make it worthwhile for taking on our investment. And so hopefully that is going to accelerate it. But at the same time, we have to look at that. But we do something very similar to what Lokesh was talking about. We also have our returns threshold, as we talked earlier. Ours is roughly 3 times our money over our hold period. And so if we believe a company can get to a certain level within, we typically will model things on a 5-year holding period. If we think companies can give us that 3x return within that time frame, then we sort of say, okay, that feels like a reasonable value. But we also then will look at more fundamental valuation methodologies. We'll look at a market. You talked about market comps. We will look at market comps to see what other similar companies within that same industry are trading for. And partly that's valuable for figuring out what's fair today, but also it's important to understand what our exit is likely to look like on the back end when we go to sell the business. And then we'll also look at the income approach. So we'll look at what the cash flows are fundamentally generating from the business, and lay all those things out. It's very rare that we would apply the asset-based approach where you're looking at just at the value of the hard assets. Frankly, as a growth, it's hard. If something's being valued at that level, it's really hard to think of them as having an ability to generate a 3x return. It's probably not going to happen. So we're generally looking at market comps and income, and then doing sort of a sanity check based on where we think the company is going to grow within that 5-year period. So we can, obviously, if the company's growth rate is significant, if the use of capital is really compelling, if they are at an inflection point, we can afford to pay an above market value based on the income approach or based on the market, comparables, if they have things that are inherent in their business that are going to allow them to sort of outperform the market on a going forward basis.
So companies that are growing extremely fast are going to have a lot larger forecast. So how much do you let that factor in? Let's say you have somebody who's doubled in sales in the last 12 months. How you run into the law of big numbers at some point, right?
Yeah, I mean, it factors in. The simple answer is it factors in a lot. I mean, a company that's growing really fast, right? It's a lot easier to get comfortable that a company is going to temper, right, off of what is currently a really fast growth rate than it is that they're going to accelerate off of a relatively flat growth rate, right? It's a lot easier to get comfortable that a company is going to go from 50%, annualized growth down to 30% than it is a company who's been historically performing at 10% that they're all of a sudden going to accelerate to 30%, right?
Right.
And as a result of that, the more comfortable you can get on, and this is where I think Lokesh's, comments resonate, quality of the management team, the product, the market, their go-to-market strategy, their historical track record, all those things factor into an investor's confidence level of what the future is going to look like, right? Whether it's me or whether it's Lokesh, we have the fundamental benefit. Lokesh has to take, he unfortunately takes product risk, right? Because a lot of them are ideas, they've been sort of validated. In our case, we try to avoid taking product risk, so we're primarily taking market risk and execution risk, right? Which is a lot easier to diligence because there are a ton of really good concepts where you either just run into a product problem. It expands the number of variables exponentially, which is why he both needs and deserves a much higher rate of return, and why what you do is to me is almost like magic. I don't know.
Yeah, there's probably some luck involved, I would assume. I've been lucky a little bit, and I hope to continue to be
Keep
lucky.
being lucky.
So hang around lucky people, you become a little bit more lucky. Thinking about the market risk, though, are there market risk and market opportunity? How do you weigh out that equation? I suppose so.
I think part of it depends on where you are in the economic cycle, right? And what type of industry you're investing in, trying to figure out. Where we try to invest where we feel like the upside opportunity outweighs the downside risk, right? And that's another big factor of sort of where valuation settles in. Where we look at it and say, well, you know what? We think at this value, we think there's more downside risk than there is upside opportunity, where it's probably too rich, right? So, it's definitely a trade-off, but usually, markets have, fundamental tipping points, and it's pretty easy to get a sense for where you are on the spectrum at a given point in time and whether there's more upside risk or downside risk. For example, just take interest rates right now. I think the fundamental, view is that interest rates are reasonably stable, but there's probably more upside risk than there is downside risk just because they're so low.
Right.
To start with, and other variables kind of fall into a similar bucket.
How important is it to you that someone become number one in the market and be able to have, because it gives you pricing power, it gives the ability to have higher margins if you're well positioned in the market? Yeah,
it's a great question, and it's not important at all. For us, we, be number one in the market takes a really big company and a really big idea, and frankly, we like niche businesses, right? We like companies because if you look at companies that are competing in the really huge markets, yes, there's a huge opportunity. There's also an awful lot of people chasing that huge opportunity, right? And so you have to be really good, really lucky, and have a lot of things kind of all come together. Whereas if you're operating in a niche market, you probably have fewer people who are trying to figure out other ways to beat you in that marketplace. And you can build, we can invest in our mindset, we can invest in a very nice $20 million company that over 5 years grows to $40 or $50 million, and we're going to generate very, very nice returns, right? For our model, that works, right? For a venture capitalist, for them to invest in a $1 million company, or let's just keep the math similar, right? A $2 million company in hopes that it goes to $4 or $5 million. I mean, that's a yawn. They wouldn't exist for very long. And so it's just they need, for the most part, and I want to speak for Lokesh, but having a big idea and having a big market and a big market opportunity typically is much more important to them than it is to a later stage investor like us.
How would you respond to that? Does it have to have a big market, Lokesh?
Yeah, so it's proportionate in that regard, right? So I agree with Curt completely, but you have to think about so let's say, we were in IT services, right? And we know that market space was $10 billion, right? So for us, what is important is the ability to grow from that 2 million in that example to the 25 million, to the 50 million, right? So we are also looking for the similar bigger market spaces. We don't need them to be the leaders of that market
space. So it doesn't need to be a disruptive type technology.
No, but it needs to have the ability to scale 10, 15 times, right? Because as Curt rightly said, if they are going to go from 2 million to 5 million, and we've seen those presentations in the past where entrepreneurs come and say, hey, in 3 years, I'll go from 2 million to 5 million. And we go, not only are we not going to invest, I wouldn't take that deck to another VC, because at the end of the day, that's just not exciting enough for the VC or doesn't provide the returns necessary to the VC's investors.
Okay, maybe we can talk about some specific industry types or even some specific investments that you've made, because I think some businesses they're going to comp out, they're going to be a multiple of EBITDA or a multiple of earnings, and some are going to be based on top line. So thinking about that, so what industries, and either one of you guys can take this question, what industries are more geared toward being valued on top line? I mean, is it mostly a software company that's got a super high margin?
For us, because of the two sectors that we focus on, technology and healthcare, what we do find is that the software SaaS-based companies where the revenue is recurring tend to have multiples based on revenue, right? Because the general concept is, at the end of the day, everybody cares about the bottom line. Mm-hmm. But the general concept with these software companies is that at some point, if they wanted to stop their investing in their growth, they have a recurring software revenue. They would spend very little amount of money in terms of maintaining the software, and they could drop huge bottom lines, right?
You bet.
And that's why they can get these multiples of the revenue there. But when it comes to healthcare or other aspects of technology, at the end of the day, it does boil down to eventually how profitable are they going to get, and therefore, what's the multiple?
You bet. So when you go to exit a company, you're helping. Well, when you invest into the company, I know with like eScreen, you're the lead investor, so you're setting the market price. You're determining that stuff, and then when you go to sell the company, ultimately, how much influence? How do you go about helping decide how to value it when you go to sell the company or go to exit?
So from an exit standpoint, a lot of times the market drives the value, right? So the investment banker or what they feel is the market comparables and the price associated in that industry, they determine that, and then the quality of the buyers interested in the deal determine that. So we don't tend to determine the price at which it exits, but we do tend to do. When we get into an investment, at that point, we are trying to determine what the market multiples will be when they exit, right? And after that exercise is done, now it's whatever the market multiples end up being.
Somebody coming in looking for a Series A, they're not going to have an investment banker,
Yep.
And you may come in and go, listen, why don't we be your lead investor? We see the company is worth this. Do you want us? And then you take it from there and go help them raise the rest of their capital.
Right, and that's exactly right, Mark. And I'll give you some numbers So in our first fund, we ended up investing in 15 companies. But to invest in those 15 companies, we made 18 offers.
18 or 80?
1-8.
1-8.
And three
Oh.
companies basically said, no, we didn't want your money in those terms, right? 15 took our offer, right? That same number for Fund 2 is we offered 23 companies in term sheet, and 18 took our term sheet,
Okay.
right? So 5 said, no, your money's too expensive, or they are finding better terms with other VCs, and that's okay, right?
Yeah. Well, what you said, those ratios don't seem that dissimilar. I mean,
Yes,
so is that, you think that's typical in the industry, or is that Moneta specific?
No, that's Moneta specific, and I do not know what that industry number is
Okay.
on that specific item. I don't know, Curt, if you know.
No, I don't.
Yeah.
I don't know what that number is. One thing I was going to say though is, I guess it's circling back a little bit to your question about the market leadership, you know, and being number one, and your comment kind of now about asking about the exits. I mean, one of the big advantages about not being number one or even being number two is ultimately we do need an exit, right? And if we're the biggest in whatever our sector is, you know, who's going to buy it? Right. And so we like to build, and I think Lokesh is the same. We want to build it to a certain stage, but it's very nice. One of the value add elements that both Moneta and DCA strive to provide to our portfolio companies is trying to help the management team think strategically about what that exit is and start to work very early in the investment process of understanding that and at least having the conversation about what are we trying to build this to, and take that task off of management's shoulders, since we do have that expertise internally within DCA, and Moneta certainly does within their firm as well, and say, look, we'll help you think through what your exit should be, and we'll make sure that you're putting the right pieces in place so that when that time comes, you'll be well positioned to capitalize on whatever offer. And he's exactly right. The market's going to tell you what the business is worth. If you package the business right, if you position it right, if you understand who the high value buyers should be, and then you run that process in a way to create a competitive sort of auction-like environment for it, which I know we all strive to do, the market's going to tell you what the business is worth at that stage. Much harder. The earlier you get, the much harder it is to value.
So one of the things, Curt, for you guys, you're looking at, you guys do investment banking as well. You have an investment banking arm. I know sometimes you do that. You don't do that for your portfolio companies, though.
We don't. We
Okay.
don't. We always try to make sure there's we're concerned about conflict of interest, and just frankly, one of the things that we're very passionate about is alignment of interest between us and our investors. And we want our investors to know that we're solely focused on making money as investors, and not interested at all in making money based on, you know, investment banking fees from the portfolio.
So as you exit a company, do you hire an investment banker typically?
We typically do.
Okay.
Yeah.
And how about you guys?
So in
Lokesh?
many of our cases, so I would say 50% of the cases we end up with investment bankers, and 50% of the cases it's just a strategic that loves that particular technology, wants to take us out there. Where there's a formal process that we want to go through from an exit standpoint, that's when typically we have used investment bankers. A lot of times, because we are in the technology sector, a lot of times we will have unsolicited, offers, and if we feel that that's the right offer, we'll take it.
Okay.
Right. So we have exited in 2 companies where we were not really looking for an exit. And
You got the call.
We got the call,
Interesting.
and we felt like the valuations were right. And
Well,
we
I
took
mean,
it.
you guys both, we've all been talking about comparisons and, getting the comps. Where do you get that information from?
Well, we subscribe to a very expensive database that provides us with a lot of market comparables that the general public would not have access to. And so we use that. We also do kind of industry research, independent industry research. And it's really those 2 methods that provide the bulk of the market comp.
How about you guys? Do you guys?
Crunchbase is out there, and you can get a lot of data around Crunchbase, and so that's one source. And in our case, remember that again, the industry multiples, we're trying to project out 3-4 years in terms of the exit and working backwards, right? So we're not trying to project, we're not trying to say, how many companies at 2 million revenue with this kind of growth rate, what's the valuation comparables in the market space, right? That data is very difficult to quantify because there's so many other factors that go into that, right? So as long as we can get industry multiples, and at this point after 5 years we have a pretty good sense of knowing which software recurring companies, typically this is the multiple for healthcare companies, and that's only being used in the exit scenario to come up with the current multiples.
Right. So, Curt, you guys, as being a private equity company, you feel that you have to buy right a little bit more than maybe an earlier stage investor who's looking more for the high risk, high return kind of thing. You have to really work the numbers on the buy side a little harder than maybe what Lokesh does or what I do.
No, I don't know that I would necessarily characterize it that way. We have more data to work with, right? And so we have more information to review and to factor into it. I don't know that it's any more critical that we come in at the right valuation than it would be for Lokesh.
Okay.
If anything, it seems like it maybe is a little bit less critical because our returns thresholds are not as high. And, we're in our second fund now, just largely invested out of our second fund. We've made a total of 15 investments, and we've never had an investment go to zero, right? And so that's one of the nice things about in the private equity world, where you don't have to make up for investments where you lose principal. Then you don't have to have the 10x
Right.
returns to make up for those zeros, right? And so I don't know that it's necessarily more critical. I don't know. What do you think? Do you think it's
So
more critical for one or the other of us?
No, I don't think on the buy side, you strive to optimize the buy, at least on the VC side for sure. And I would say that Kurt's 100% right that on the VC aspect of the business, you expect half the companies to not return principal, right? We were fortunate in our first fund that of our 15 companies, we ended up with 2 returning less than the principal, right? But when you do that, we compared ourselves against the market. Most VCs have 50% of their portfolio will not even return the principal.
Yeah, that's a phenomenal.
Yeah,
for those
that's
who aren't
great.
familiar, that's a phenomenal track
Yes.
record. And
And I think some of that, having that $500,000 threshold in terms of revenue, actually helps us in that regard.
Did
right?
you have any return, say, enough to cover everything? Did you have anybody that was 100x?
So we're still early into the game. Our first fund is 5 years old. It's a 10-year fund. There is a company that's tracking at 5x return, but it would almost return 100% of the fund.
100% of the fund,
Just
yeah.
one company that would return 100% of the fund. And the interesting thing about that is that, that company, we're targeting an exit this year. So we've spent a lot more time with investment bankers and things like that.
Yes.
So we'll know how that plays out. But typically in a 10-year fund, you start seeing those things emerge year 7, year 8. So if you're fortunate enough to get one in year 5, we'll certainly take it.
Yes. Did you agree with the statistics in terms of, did they jive with you in terms of the number of offers? Lokesh makes 18 offers and gets 15 to say yes. Is that, do those percentages seem right when it comes to the private equity world?
it's a little bit. I think it's a little bit different process. Because generally when people come to Lokesh, they're looking for money. And we have circumstances where we will go out and start talking to companies that aren't necessarily looking for money, but we think that they're interesting companies that we would have an interest in investing in. And so in those circumstances, it's a little bit different courtship process. So I think the statistics, trying to compare the statistics would probably be a little bit of comparing apples and oranges. But I think, for what he's doing, my takeaway from that as it related to that is that what Moneta's approach is to valuation is they're a fair investor, right? Those were very high statistics in my mind, which we strive to do as well. I mean, let's face it, this is a relatively small community that we're investing in, right? And as you know as well as anybody, reputation matters when you're in a very small fishbowl, right? And if either Moneta or DCA were to, be predatory in terms of how we approach valuation, word would get out very quickly, and and that's just no way to build a long-term business. And both Lokesh and I have had this conversation, and we both aspire to have long-term franchises within this very small community. And the only way to do that is to be fair. I think it also, bodes well for people who come to talk to us is both Lokesh and I come from an operating background. We've both been on the other side of the fence. We both genuinely, like you, we genuinely root for the entrepreneur. We know how hard it was for them to take their business, risk everything, and go from where they started to wherever they are now, whether it's with Lokesh looking for $1 million or us looking for $5 million so they can take their company from $20 million to $50 million. And, we're not looking to steal their business. We're not, he's not. We're looking to just invest on terms where if things go well, right, you never have to have any difficult conversations. But when things don't go well, Moneta, DCA, we have investors who've trusted us to invest their money on prudent terms. And so what our litmus test is internally is, let's assume if things go bad, can we look a Mark Haney in the eye and say, you know what? Here's what we did. Here's why we did it. Here's why we felt like this was a fair value, right? And have them not look at us and go, you guys are idiots. Why did I trust you with our money? And so, that is very much our litmus test. My sense is, from Lokesh's perspective, that's something that he uses probably from time to time to guide his decision making as well.
Mm-hmm.
So occasionally people will run a process, or very often people will run a process. I'm just assuming, Lokesh, you see that often where they've decided they want to go out and raise some financing, and they've already decided what the offering is going to be, and then they come to you. Is that a fair statement? How often does that happen?
That does happen in cases where we are just going to be a participant in the round.
Right.
So, Mark, if they're raising $5 to $10 million and they know we write initial checks of $500,000 to $2 million, then we would want them to come to us once they found their lead investor and say, here's the terms that the lead investor is giving us. Would you want to participate?
Right.
But in other situations where they want us to be the lead, they can come with whatever their ask is.
Right.
That's going to have no bearing on what we come up with as terms of the valuation.
And so the valuation, you're not that influential in the valuation at that point. And so I guess the same question over to you, Curt. I'm assuming, I was kind of thinking that people would run a process and then come to you, but I have to assume that that's not the case. You're seeing people where you're basically like the lead investor for them.
Yeah, we almost always are. Mm-hmm. There have been a couple cases where that hasn't been the case, but it's always been because of some pre-existing relationship that we had typically with management.
And the reason I asked that is because the conversation in my mind was that private equity and venture capital at some level during the due diligence portion of the investment, sometimes you notice things that can cause you to not want to do the deal. Sometimes you can notice things that say, hey, the company's worth a little bit less than what I thought it was. So thinking about that, the value of the company, what do you see in there that makes the value of the company be worth a little bit less, and you want to go back and sort of renegotiate the terms or basically ding them on, let's say, their quality of earnings? Does that happen kind of regularly?
No, not for us, not
Okay.
regularly. And again, partly it's because we work hard to try to understand the key drivers of the business before we get to that stage. I mean, we hate having that conversation. It's a very difficult conversation, and no matter how honest it is, I think there's always a tendency, and again, coming from an operator's background and perspective, there's always a tendency to believe that the investor is just trying to stick it to you, unwarrantedly.
And you're taking a minority share in the business, which I think is on the less common side for private equity. And you're also doing that, Lokesh. You guys are taking a minority share. So when you see these private equity companies coming in and taking 60% of the company, and they're going to have influence over the company, I guess maybe they're more worried about buying right, because I've seen this happen with other companies I've been involved with, and you basically go into the due diligence period expecting to get beat up a little bit by through that process, and apparently that's not common for you guys.
Go ahead, Lokesh. I'll hold off.
So on the exit side of things, that has happened several times for us.
Okay.
Right? So where we get a term sheet, the company is valued at $100 million in the term sheet, everybody agrees, go through the due diligence, and then, invariably, obviously, every company has positives and negatives, and we have had situations where the private equity investor or the strategic comes back and says, well, here's the 9 things we like, but here's the 3 things we don't like, and these 3 things cause us to reduce the valuation.
Yeah, it never goes up in value at that time. Wow, we found some really good stuff we didn't know about.
Yes.
But I think the important distinction is, around the concept of do buyers or investors go into the discussion expecting to do that and planning to do that, right? Which I can tell you from a DCA perspective is absolutely not.
Yeah.
When we make a term sheet, when we issue a term sheet, we expect to close on those terms, period, end. But reality is, when someone is marketing the company, whether it's to get an investment or to sell it on the back end, to Lokesh's point, they're trying to present the company, and appropriately so, in the most positive, favorable light that they can. Well, when you do that, you run the risk of having the reality of the situation be different than the perception that you're trying to create, right? And so if you've created a perception that the company is going to grow at 40% and your pipeline looks like this, and then you start to drill down and realize that the pipeline wasn't really a pipeline, it was a wish list, right? Or it was a target list, and you have to say, guys, I don't see the projections playing out the way that you represented them to us. And so we're going to have a hard conversation about that. But we work hard to try to do as much of that as early as we can to avoid the difficult conversations, because it's no fun for the company and it's no fun for us.
So both of you guys have talked about price and terms a little bit, and we haven't really talked about terms that affect the value of the company. Is that, when you think about the terms affecting the value, is anything that comes to mind?
A lot comes to mind.
Okay.
I mean, there's an old adage, you can name your price or name your terms, but not both, and so there definitely is a yin and yang between those two. And there are a number of different terms, whether it's, liquidation preferences. I mean, typically minority investors, whether it's early stage or later stage, will invest in a structure that's a convertible preferred structure, right? And the terms of that conversion, are significant. And so paying attention to that, typically, normal would be a 1x, 1 times.
Is that typically what you guys do at the private equity level? You doing a preference?
We do a convertible preferred, and it's
okay.
if we do a full buyout, then there's no real point of doing preferred. It's just we own the company, and so we'll just hold common there is no everybody else. It's just us, and then we'll give options to the management team. But if we're a minority investor, then we typically will have preferred stock, and as much as anything, it's because we are a minority investor and we need to have certain rights that will prevent the controlling shareholder from taking certain actions that would be adverse to our interests. So basically, just not treating us unfairly. It's interesting because again, I was on a call earlier today and just trying to go through the same question. So it's a good one, and I'm sure on the minds of many of your listeners. Explain to them that these are not an attempt for us to take undue control or to tie your hands. These are really there, when you get into the details, to prevent someone from being tempted to do something that would just treat us unfairly.
At what point, let's say on the preference, would it be considered predatory? I mean, we hear about these things. You have a naive person out there going to try to raise money, and at what point is it like, wow, that's considered predatory. You want to touch that one?
Yeah. So can I?
Please, please.
So I want to give an example actually. So typically, like Curt mentioned, it's the liquidation preference is 1x going in, and sometimes it's participating, sometimes it's not participating on our side. Okay.
And can you explain that to the audience
Right,
too?
sure. So 1x participating liquidation preference means that I get my money back first, and then I participate for the percentages that I own of the company for the remaining money. When it's 1x non-participating, it means I get the higher of what I invested, right? Or what my percentage is. It's one of the two.
One of the two, yeah.
Right? So typically it's 1x non-participating or participating depending on the deal. And I remember this company that I was mentioning, which is going to return, which we think is going to return almost all, our entire fund. When we had the initial discussions with them, we valued them at $6 million and said, we will invest at this. The founder was so sure about his success and the ability to not take more money that he came back and he proposed to us and he said, I will give you, instead of this 1x non-participating, I will give you 2x participating.
Oh, it was his idea.
It was his idea. But I want a valuation of $13 million.
13?
1-3.
Oh, okay.
Right?
So we want.
So it's like, hey, if I only grow to 20 million, you guys will make a lot more money than you
Yeah.
anticipated. But I think I'm going to grow to 100 million, and therefore
Interesting.
I want to keep more of that money, and I'm okay with paying you
So
2x
he
participating.
de-risked it at some point, but it was still your best
It was best
one.
right. And so and if you looked at it in vacuum, my point to this was that if you looked at it in vacuum, Mark, and somebody looked at it and said, "Oh my God, Moneta has 2x participating."
Yes.
They were very
Predatory, whatever,
on this
yeah.
one. But that's not the circumstances. The valuation had something to do with it.
I think that's an interesting thing. The price and the terms, it's
Yeah.
you can't look at either one in a vacuum, and you can't look at the term predatory in a vacuum as well. Do you have any other thoughts on terms? I mean, we talked about the different terms, liquidation preference being one. Are there others that sort of affect the value in a certain way?
So what happens when you do a down round? Is there how does the earlier investor get treated? That's another one that, there are certain market norms, but can be different depending on, the deal itself.
Explain what a down round is.
So down round is,
Company didn't do so well.
We invested at 100 million valuation. Company didn't do as well, or the next round investor just thinks it's valued at less, and so says, "Hey, I'll invest at 70 million," and the company wants to take that money.
Yeah.
Hey, I invested at 100 million. I invested earlier. How do my shares get treated? Do you give me, some anti-dilution protections? Do you give me some ratchets? Do you help
Give
me
you
out?
some protection if
some
the thing went
protection.
down in value on us.
Yes.
Yeah.
Right. So there is that term is another one. Board seats, who can vote on what is another term.
What is that one? I'm sorry?
Board seats.
Oh, board seats, yes.
Right. So who has?
Yes. So some of these are more governance related, and some are more on the economic side. Which, I mean, do the governance related terms affect the value at some level?
Oh, absolutely. If the governance, sometimes they throw the deal off.
Okay.
We have had, of those ones that like we made 18 offers and 15 accepted. Well, in one of them, they came back and they wanted to take out so many of these governance factors that it was a non-starter for us. Right. So they didn't necessarily disagree with our valuation, but they disagreed with the governance that we were putting in place. Right, and which we thought was customary.
Yeah.
And at some point, it also, gets you wondering, why is that such a troubling thing for them?
Yeah.
Okay. If
Right,
they're pushing
because-
back on a board seat, or what other terms are
Right,
there?
and it's what do we get? One board seat out of five,
yeah,
typically. I mean, it's not like we're going to control the company.
Yeah,
And I mean, one that that came up recently was one of the things that we asked for is an opportunity to approve executive compensation. Right, and typically we do that going in. And as I explained to the folks I was talking to, is that all that really is not that we want to control how much you are going to get paid. And usually we'll enter into a long-term employment agreement with the key executives, so they know we've worked through that early on. But what we just want, again, getting back to my earlier point, that it's really just an getting screwed protection, is we don't want them to all of a sudden say, okay, we decided 150 isn't right for us. We've decided it should be 750,000.
Let's drain the company.
Each, right? And all of a sudden, all you've really done is change the capitalization table. You've changed the allocation of who gets what, from the company's proceeds, and that's just not fair. And at the end of the day, all we're really looking for when we issue a term sheet is just treat us fairly. Give us a seat at the table. Let us have an opportunity to talk about the things that are really important to the company and they're going to help to drive value. And that's really all we're looking for, because we recognize 90% of the investments we make are minority investments, and I know that's the same for Lokesh. And so we're not going to control the day-to-day operations of the business, or frankly, even the strategy of the business. We just want to make sure that we have a voice and that there's not going to be something that happens to us that is embarrassing when we have to tell our limited partner investors about it.
Yeah.
And the way I look at that is that we don't have the ability to tell you what to do, but we have the ability to prevent you from doing certain things.
Yeah.
Right?
Yep.
That's,
Well said.
No,
that's exactly.
Are there other topics related to what companies ought to be worth or are actually worth that you think we ought to cover today? Anything else that you're thinking or on your mind?
One example I wanted to just give was we have a portfolio company that started with a very high valuation, and they got some investors, high net worth individuals, to invest at what I thought was very high in terms of valuations. And we went in. The company had actually progressed quite a bit since they got the earlier investment. We went in and we said, "Yep, you've made great progress, but you're worth half this."
Okay.
Right? And the founders agreed. They said yes, and they were nice enough to their previous investors and repriced them at half the valuation. They knew that they got a deal which was not market, right?
Yeah.
So sometimes people seek these higher investments and so on. It just looks bad on that company to have a down round when they made such amazing progress.
Well, how important is that? Let's talk about that for a second. So when you're going out to raise money, especially an early stage company, you got the angel investors, then you've got your Series A, and you go to Moneta and they come on board, and then you're looking for these subsequent rounds of investment. Ultimately, you're going to sell, maybe go public somehow, something like that. But thinking about that, if you don't see regular momentum in the value of the company, then it's a bad mark on your future rounds?
Yes, I mean, you want the company to be progressing, but not necessarily in terms of the raises, right? So I have had companies which go, hey, I want to raise money because I want to show that I progressed in valuation. And I'm like, that's absolutely a bad reason to raise money, right?
Okay.
If you can utilize that money to grow faster, absolutely go raise it. Right. But sometimes, in our company, we have portfolio companies where we invested we have one particular company in our second fund where we invested at a 4 million valuation. Right. And they didn't do any more rounds. And this month, they're closing a round at a 45 million pre-money valuation, but they didn't have anything in between. And all through that exercise, they were
great.
which was great. I mean, as an investor, it was amazing. But to me, the founder was very worried that, hey, every time somebody looks us up, they go, last round you guys had it was at 4 million. Are you really a small company? And they're going, no, we're not. We're doing well, right? So there are sometimes other reasons that come into play for the valuation.
Do you keep money on hand for follow-on investment, even if it's at a higher valuation?
And Mark, that was something we learned from our first fund, right? In our first fund, we had 1:1 ratio. So we invested $1 and we kept $1 for follow-on investment. And we just, learned from that and realized that wasn't enough.
1-to-1 is not enough.
Not enough. So in our second fund, what we have done is for every dollar we are putting out there, we think somewhere between $1.50 to $2 is what we're keeping for follow-on. And that we think is the right number.
So when you invest into the follow-on, is that typically a Series B?
So typically it would be a lot of times we'll come in at seed and it'll be a large Series A.
Okay.
Sometimes we came in at early Series A and now it's a Series B.
Okay. And
so
then you have some kind of pro rata rights that give you the right to jump in and buy alongside the next
new
round.
investor.
Yeah.
Exactly right.
Okay. And now, is that even Is that even a consideration for you guys?
We look at it, but we look at it more on an individual case-by-case basis. Again, most of the companies that we're going to invest in are profitable. And so if it's a big acquisition strategy or if we anticipate that there are going to be subsequent rounds, then we will hold some back or at least be mindful of how much we invest initially to make sure that we have the capacity to invest more if they are going to need more capital. But we don't have a prescriptive target in terms of how much we hold back.
Okay.
And one other comment
Yes.
around to add to that would be, so one way we are different from the Bay Area VCs, right? There's a lot of strengths in the Bay, but one thing that is different about what we do here is we cannot count on as much follow-on money as is available to the Bay Area VC, right, for subsequent rounds. So one thing we are looking for in these companies is the ability to get cash flow positive if they wanted to at certain stage, right? So a Bay Area VC, so as an example, it has a downside too. So as an example, we would never invest in LinkedIn, right? Because the model required more and more rounds of funding.
Right.
The first dollar of revenue comes in, and let's say $600 million raised, right? That just wouldn't fit in the Sacramento model.
There's got to be a pathway to profitability for you,
Quicker.
cash positive. Does that mean a company is worth less if it's in Sacramento?
No, it does
Because
not.
if it doesn't have access to big, follow-on funding, as good of access.
Yeah, no, the key there is it cannot count on that follow-on
Okay.
funding, right? So the ability to get cash flow positive has to be there in the business model. So if you were trying to build in a LinkedIn in Sacramento, I would worry about that, right? Because the capital access, obviously the Bay Area VCs can invest and so on, but there are jokes around which says, hey, the Bay Area VC only goes as far as their Tesla takes them. And so, what if they didn't reach Sacramento?
Yeah,
right?
yeah.
So there is certain aspects of that you have to keep in mind.
And I would argue that is probably part of the reason, at least, why Moneta has had the success that they've had with such a low number of companies that have failed. Is partly, you can get companies down in the Bay that get punch drunk, and it's all about how much money did you raise, what's your burn rate. We all remember the old days when you got valued as a multiple of your burn rate, which is, and so I think the more disciplined, the more pragmatic approach that I think we take here in Sacramento actually helps to increase the success rate of the companies that do get invested.
The funny part about that was we started with that and it seemed almost archaic. And then a couple of years back, we started hearing from the Bay, we're looking for companies that have the ability to get cash flow positive. And we're like, no kidding.
You started a trend. Let's make some money. What a concept. Let's raise some money from our customers along the way at some level. Well, guys, I want to thank you for the education. I think it's been phenomenal. I think it's a lot of kind of valuing the company 101. We're going to be having an event together coming up, I think in a week or so, where we're going to bring in people and talk face to face, let the audience throw out some questions. But if you had maybe just some advice, just like closing thoughts on this topic, advice to the entrepreneur out there that's thinking, hey, I'm going to raise some money at some point. How should I approach this valuation subject?
My advice is don't let valuation drive your decision-making process. At the end of the day, all that the value, for the most part, the primary thing that the value determines is how the spoils of your success get divided up amongst the different parties, right? And what people, in my opinion, don't spend enough time, so that affects the magnitude of your success as an entrepreneur, right? But what people don't spend enough time on when they're going through the fundraising process and the valuation conversation are the different aspects that impact the likelihood of success, right? get the right amount of capital, get the right partner, get someone who you're going to be able to collaborate with, right? And let that drive your decision-making process, because at the end of the day, maximizing the likelihood of success is a lot more important than figuring out how the spoils of that success get divvied up in the end.
Well said. How about you, Lokesh?
I mean, Curt just took words out of my mouth. That was very well put, Curt. And I was going to give another statistic around it. So you look at those 3 companies in Fund 1 or the 5 companies in Fund 2 that didn't accept our term sheets or we couldn't work things out. Of those 8 companies, 2 were able to get much higher valuations than what we offered. 2 got similar options with some different terms, and 4 went out of business. Right? So sometimes, to Curt's point, and as an entrepreneur, I'm not saying this as a VC, as an entrepreneur, I took what might not have been, in my mind, the right valuation, or might have been lower than my valuation there. But at the end of the day, I was able to return 4.9, to my investors in my company because I took those suboptimal valuations, but I had the money to do the things I needed to do.
Yes, and it made the ultimate company valuation. You did what's right for the company in terms of valuing the company by putting the right partners in your life. Guys, great conversation. Look forward to doing much more of this. Thank you for what you're doing for the Sacramento entrepreneurs. The ecosystem here, I think, is getting stronger. The confidence feels like it's increasing, and it's guys like you that are making it happen. So thanks a lot.
Likewise, Mark. Thank you.
Thank you, Mark, for what you do too
Thank you.
in the region.
Thanks for watching today's show. My goal for every episode is that you find a takeaway, something tangible you can use in your business today. And if you have a comment about a favorite takeaway, feel free to put it in the box below. And if you have a topic that you'd like me to bring up on the show, don't forget to let me know. And also, don't forget to subscribe to our YouTube channel if you want to learn more about entrepreneurship. Because at Haney Biz, we are always by your side.